So, they will probably go down. Yeah, they will definitely go down. So you can just look at any bank now. They're going down by a lot. And one thing is that I want you guys to, I advocate that buy the trend and don't resist it. So let's say it's in the late or the recession period now, and you went to go and buy banks, then you will see, your holdings, you'll see that your stock will just drop and drop. But of course, if you don't realize it, then it's okay lah. But I feel that it's opportunity cost. There is opportunity cost. So, and also anticipate one cycle before it happens. So if you're at the recession period now, you want to look at, all these kind of stocks. So if you're at the mid period, at the peak, you want to look at, consumer staples, like let's say, Sheng Siong. Okay, next. So some things to take note of when investing. So it's quite so invest in businesses you understand. So when you buy the stock, you're actually owning part of the business. So invest with a surplus funds. If you need that cash, right, for let's say mortgages or paying of bills and all that, then you shouldn't invest in it. And once you commit your funds, if you need to have the appetite to stomach the ups and downs. So let me just give you a brief of what I mean. Let me give you a example of what I mean. So share screen first. Okay, so this is around the October, the late period of 2019. So if you felt that the recession was coming, so some of you might have anticipated a recession even during 2018 or 2019. So if you felt that the recession was coming, you would buy in this Sheng Siong here, okay, at maybe around $1.15, and then you will wait, or maybe you guys could have bought at $1 and wait. So you wait for a while, and you wait like until here. So this was around the late until you can see around here it's March. So why was there such a drop was because everyone in the stock market were selling off their shares for cash. All right, you can tell here during March everything was going down, almost nothing was going up. So at this point of time, you have two choices. You can realize the loss if you needed cash. So this is why I advocate that you should always invest in funds that you don't need, and you need to have the stomach to you need to have the appetite to stomach the downs and then the ups. So if you still believe in yourself, you could have value averaged in, and you could have purchased this stock at another $1. So if you believed in yourself and you just waited for about less than a month, it will be $1 to $1.50, and this definitely outperform the stock market. All right. So another example would be in Walmart. Walmart is something like Sheng Siong. Okay, so it's grocery retail. So as you can see here, during March, they were very volatile. So you had to chill, and then if you got it at let's say $119 here, and then it went down to 109. Do you sell it or do you wait? So you know that it's a defensive stock. It goes up to 130. So if you felt that had hit your target price, you could have sold it, or you can just wait longer if you feel that they will grow even more. Okay, so let me just change back to my slide. Oh. All right. So another thing is that environmental changes, the global level, and then go down to industry and go down to company. So I think there was one guy who just asked just now, like what I think about Tesla. So like using Tesla as an analogy, I would say that for environmental changes in the global level, you can tell that everyone is very we're just very conscious about the entire world now. You know, we are eco-friendly and all. So, and then you can tell the consumers are changing. Okay, and then number two is you can see that China, they are pushing for full electric. Sorry, they're pushing for half half of the cars to be full half half of the cars to be full electric EV. Okay, and then you can see in Europe by 2030 or 2040 they want full electric too. And then you go down to industry. Then you look at the industry, it's the automobile industry. And then we look under industry, you can see that, you know, if you think that it's Tesla or you think that it's Volkswagen or Mercedes, that will do well. So this is something that you look at. So let's say, you know, COVID-19, China lockdown, everyone locked down, you can only go supermarket. And then you look down at industry, where you think that the industry is, so it's consumer, and then you go down company. So you can look at, you know, Sheng Siong or Dairy Farm. For SWOT analysis of Sheng Siong, their strength is they have strong branding, market presence, loyal customers, and price competitive. So their loyal customers are mainly our parents' generation. So, and the weaknesses are the income is tied to the number of stores they have, and opportunity expanding into China. So the threat is space constraint and losing younger customers' market share. So people like us, you know, we are more inclined towards buying from RedMart or, you know, just purchasing our groceries online. Whereas our parents, they like to go down and choose this and choose that, you know. So why Sheng Siong? They are defensive stock, circuit breaker and recession proof. So and okay, number two, debt free. They have a lot of cash, low beta, and low exposure to other countries and sub industries. So defensive stock. So right now in Singapore, they are all of the outlets are open, and in the current pandemic and recession, people still buy groceries and household goods. And okay, this is an interview by the CEO on 2018 with Straits Times. He said that when people started moving away from restaurants during SARS, we enjoyed brisk business because more people started buying food to cook at home. So unfortunately, they got listed later on, like 2012, 2013. So we don't have the data for how well they did in 2008. So, and this COVID thing, right, is a replica of what's happening in SARS. And I would say that it might be even worse than SARS. So they are debt free, okay? They have zero debt. They don't owe anybody money. And they don't owe any banks any debt. So they don't have to worry about their interest coverage and their debt coverage. And they have not had that for the past 5 years too. So as you can see here, the short term, yeah, there might be some constraint. The short term asset seems like very close to short term, but the long term is really fine. So this is an extract from their annual report from the balance sheet. As you can see that, you know, 196. So I just added all this up to make sure that both tally. So most of their current liabilities, the money they have to pay, is to trade and other trade payables. So these are mainly from suppliers, you know, those farmers and producers. And then their current asset, yeah, they got 133 cash. So number one, for the cash to pay, if they had this amount of cash today and they paid everything, it's also quite healthy. But usually they don't do that because trade and other trade payables, they have they can negotiate for quite some time. So you can see that their asset turnover ratio is 2.05. So if you take 2.05 times the amount of inventory they get, it will be 140. So 140 plus a little bit of cash will be more than enough to cover their trade and other trade payables. So they are absolutely fine in short term. So low beta. Number represents the volatility. So as you guys saw, when it goes up and it goes down in a very short period of time, volatility. The sign represents the correlation to the index. So just now we saw Singapore Straits Index during March, it dropped like crazy. Sheng Siong also dropped, but for a stock with a beta lower than 1 is expected to rise less than the market when the market is moving up, but fall less when the market when the market is moving down. So spoiler alert, we are in a recession now. So mainly the market is going to move down. So if you get, Sheng Siong when they move lesser, I think it's you lose lesser. So Yahoo Finance has a beta of 0.36 and Fitbox has a beta of 0.36. So this is the store count. So supermarkets generate more sales by the number of stores they have. We have more stores, people can access your stores and if you and just buy stuff there. As you can see here, this was 2018, probably on 2018. There's this chart saying that the main gainers have been Sheng Siong and FairPrice, and the losers have been Dairy Farm and other small players. So you see red and blue. Red is FairPrice is going up. Blue is also going up, maybe at a slower rate. But you can see that Dairy Farm has been going down. So another extract from Dairy Farm's balance sheet, can see that in 2018 they had 112 stores, and then in 2019 they had 103 stores. So for Sheng Siong, in 2018 they had 54, 2019 they had 61, and by 2020 Q1 they already have 64. So this kind of backs this trend of Dairy Farm continually going down and blue and Sheng Siong store count continually going up. This is some of the financial highlights of Sheng Siong. So while expanding, you can see that their revenue, gross profit, and the profit margin, net profit, they are all moving in the same direction. When it increases, the gross profit also increase. So there's not much inefficiency. So this is the article from Business Time. So on April 28, Sheng Siong Q1 profit up 29.9%. Staff to get additional amount of salary. So I hope that we as shareholders we get more dividend too, because the dividend not very high. So this is free cash flow to equity valuation by Simply Wall Street. This is as of today. When they in the morning it was 1.51, but now they are at 1.54. So this is what they value at 1.63. So basically, at the end of this, my executive summary will be that with the current recession and pandemic, I believe that Singapore households will lean towards buying food from supermarkets to cook at home. I personally feel that if I had to underestimate with most conservative outlook, this may persist from Q1 to Q3 2020, thus driving their earnings highly than what we have seen. So I think the circuit breaker is gonna end June. Then at that time, you still can't go out to restaurants to eat yet. So most likely your family members are gonna carry on cooking. So okay, so all these are my references, and I'm done. So thank you, and I shall pass the time to Nick.
Okay, thanks, Tian Mu.
Sorry, Nick. Yeah, so for those who have any question regarding to Sheng Siong, what y'all can do is y'all indicate within the chat. Then Tim will will get to you guys at the end of the session under Q&A. So what Tim has done, just a short summary, is that he did both fundamental and technical analysis towards the company itself and the outlook in terms of the near future and hopefully a little bit towards the mid to long term kind of analysis. That's what he has done. So yeah, then Nick will just continue.
Okay, thanks guys for tuning in. So today I'll be sharing on what is REITs and why do I choose Mapletree Industrial Trust REIT.
Oh wait, I got
MIT in short. So what is a REIT? Before this, I'm going to keep it short and sweet and also easy to understand. Okay, so what is a REIT? REIT is basically, I'm the investor, you are the investor, we all invest in REIT company, and then this REIT company will go out and buy infrastructures like hospitals, shopping malls, hotels, and then they will just collect rent. REIT will collect rent, and it will pass all the 90%, at least 90% of the earnings to shareholders. And the MAS stated that the debt to asset ratio cannot hit above 45%. So yeah. By nature, if you don't know, REIT is dividend income stock. An income stock is generally quite high in dividend yield. To me, it has to be at least 5%. The lowest REIT dividend yield is, I think, about 3.9 to about 4-ish. The last check today, I think Capital DC was trading around 3.9% dividend yield. So people usually think high risk is high return. I would say yes and no. Why no is because you need to analyze the company meticulously, look into their financial highlights, the business pattern, what kind of business they're operating, all these. And the important about REITs is sponsors. So for sponsors, I'll come to that later. So basically I'm going to clear the misconception of high risk, high return. So basically, I'll spend a little while here on why I like MIT. So MIT has 114 properties spread across Singapore and United States. United States, they have all the data centers there, and Singapore, we have manufacturing infrastructures like flatted factories, like the one we see in Ubi area, and business park buildings, ramp park industrial infrastructures, like the one we see in Tuas area, high-tech buildings, example HP. So what is high-tech buildings? High-tech building is more like companies, big companies that are into business of technology and technology and engineering. Yeah. So basically, my macro view of MIT is looking at the tech industry, right? I feel that the demand will increase a lot, and it will require a lot of data centers to store a lot of data servers, rows and rows of data servers to facilitate the infrastructure of the upcoming 5G technology, blockchain and fintech, artificial intelligence, all these. So recently, Alibaba spent billions of dollars into cloud computing because of coronavirus. And as you can see, another example of Zoom, this platform we are using right now, the CEO, Eric Yuan, became a millionaire just within a month. Yeah, so I feel that COVID-19 has actually drove demand for cloud computing. Yeah, and because of COVID-19, many businesses have viewed their strategy a different way, and it has also came up with. They feel that because of COVID-19, opportunities also has risen. So yeah, COVID-19 can actually change a lot of things. Moving on to financial performance, for the next 2 slides, I'll intro you to all the key ratios that I always look into. So the common ratios are this and the next slide as well. But before that, generally, I think MIT has a healthy earnings, especially I feel that they are able to maintain their expenses pretty well. As you can see, the financial year 2020, they are able to stomach the cost very well. So their profit earnings is quite close to their revenue. Property yield is 5.4%, which I think is okay. Minimum, it has to be 5%. Gearing, debt to asset ratio, is 37.6. Lower than the 45% of MAS rule. And the interest coverage ratio of 7.7 times. So for those of you who don't know what is the interest coverage ratio, it means how many times MIT can spend on the interest expense using their earnings. Yeah. So with these key ratios, right, I want you guys to take note. Don't Google in general if you want to find out what is PE ratio. Because if you want to find out PE ratio, you Google with the industrial average. Because if, for example, I want to Google P ratio for Mapletree Industrial Trust, right, then I can't compare it with MIT and Singtel because they both are different businesses. Singtel has about 34% of P ratio. So it's very different business structures as well. So yeah, if you want to Google any type of ratios, you must Google and look at the difference between the industrial average. And the PB ratio is quite high, 1.55. I feel that it's okay to be high if you want to hold long term. So therefore, I feel that 1.55 is okay. Although some of you might think that's still expensive lah, but yeah. So the lease expiry profile, the thing I want to talk about is WALE, which is weighted average lease expiry, standing at 4.2 years of overall portfolio. I feel that 4.2 is a bit low. Okay, the industrial average is about 6 years. But the thing that interests me is MIT actually negotiate with their tenants 6 years before their lease expire. Yeah, you heard it right, 6 years. And another thing is their total arrears is pretty low at 0.3%. Yeah, so basically high-tech buildings, right, are occupied by all these companies you see on the top right corner of the screenshot. HP, Equinix, and AT&T, ST, Telemedia, all these. Okay, so moving on to, let me drink water. Maybe I drink already, I can speak another different language. Okay, so due to economic slowdown, right, in trade, manufacturing sectors, of course, will be affected badly. But therefore, I feel diversification in a company is very important. So if manufacturing sector down, at least you still got data center, right? Data center is high in demand. So therefore, I feel diversification is very important, which MIT is quite good at. So short-term risks will be COVID-19, which everywhere is facing right now. But I feel that most of the big companies are coming up with relief program, coming up with tens of millions of dollars to help their tenants, to retain them so that they won't go bankrupt. Yeah. And the next thing is interest rate. MIT has 27% of exposure to rising interest rates, fluctuating of interest rates. And the good thing is 73% of its interest rates is roughly fixed. However, due to investments in US, the data centers there will of course be translation risk, which is foreign exchange risk. Because right now, recently, if I'm not wrong, the Federal Reserves lowered the interest rates to 0.25%. So yeah, that is my overall potential risk in my opinion. So lastly, at the beginning, I mentioned about sponsors, right? Sponsor is very important. So what is sponsors? Sponsors are actually companies that pump financially or financially help these REITs companies to buy infrastructures. So on the left screenshot, you can see Mapletree Dextra Private Limited is actually a subsidiary of Mapletree Investments Private Limited on the right screenshot. And Mapletree Investments Private Limited is owned 100% by Temasek Holdings. So yeah, imagine if touch wood, anything happened to Mapletree, not only Mapletree Industrial, and there's also Mapletree Logistics Trust, Mapletree Commercial Trust, Mapletree North Asia Commercial Trust. Yeah, if all these REITs were to, like for example, touch wood go bankrupt, I strongly believe Temasek Holdings will step up and help them financially. Yeah, so like what is happening with SIA right now. So in general, in my opinion, I feel that this is relatively a safe REIT. It's just like a blue chip REIT. Yeah. So I've ended my sharing. Thanks, everyone. I'll pass
Okay.
on to Kai
Thanks,
Jun
Nick.
now.
Yep. All right. Nice. Thank you. So what Nick has actually summarized for you guys is his the outstanding outline of what Mapletree Industrial Trust is like. The sectors they are allocated into, like the industrial and the logistic side for Singapore, and overseas in US they are looking more into data centers lah, which is comprises their current portfolio itself. So if let's say along the way y'all got any question that y'all thought of, they would like to ask him, yeah, just feel free and go ahead now. Okay, now is my turn. I will be sharing on Parkway Live. Can everyone see the screen? Because I'm using Duo, so I'm not quite too sure. Okay, nice, thanks. Okay, so why I decided to choose this particular company is because they are within the healthcare sector and I'll explain a little bit more in depth to them. Currently, they are part they do own 3 of the most premium I would say private hospital in Singapore itself, which attract not only local patients but foreign patients as well. And this is one of the key factors that we should take into consideration looking into healthcare sectors. Okay, my presentation will be slightly more wordy because I does it in the more format setting. The reason being is because aside from this particular presentation that I'm showing you guys, I'm also doing it to allow other investors along the way to have a look at this report itself, like other investors as well. Okay, so y'all don't have to read word for word. I'll just summarize it. So currently, they are the largest healthcare within Asia. I think with 13 years of history, with consistent growth plus low operating costs. And I'll get to that in the financial aspect later on. So you want to look things at from two particular views, from the micro and the macro view. So in the macro view, we need to know that the current population globally is currently declining. At the same time, aging population, which correlates to the demand of healthcare, will increase as they move along the year itself. So the current statistics is Singapore will range between 22.5 to 28% of elderlies above 65 years old by 2030, and an astonishing amount of 33.3% to 47% by 2050. As for Japan, it will be 42.4% of the entire population will be more than 65 by 2050 itself. So that is like 1 in 3 Japanese and 1 in 4 Singaporeans in the near future. So while looking from the macro view, it's one of the most, I would say, key indicator is that currently the healthcare industry is underperforming. And what do I mean by that is they are not underperforming, underinvested. So governments are not spending as much. So in the future, when demands such as healthcare needs, such as like your hospital beds are required, that's where they have to expand in the sense. So they are currently underinvested, means that there is not enough beds to supply the future demands. So that's something that we can look into. For the micro view, is the technological as well as the increase in healthcare expenditure. So like I mentioned, they're currently underinvested. So government at this point of time, knowing in the near future, there will be a surplus of demand. Therefore, to cater to their needs, they have to, pump in more, I would say, money into their particular sector. So you know where we're going into. Okay, so business and revenue. I think before we start on this, we need to understand what is a business and what is their byproduct, and it's a two separate thing. So example of a business, like if you look at Starbucks, their business model, those who have come to my Tuesday webinar, they would know this. So for those who look at Starbucks itself, their business is selling a third-party space. Their byproduct is the coffee that they're selling. McDonald's, their business is in real estate. Their byproduct is their fast food. Similarly to Apple, their business is the lifestyle. Their byproduct is the devices that they're offering out there. So this one we need to make it clear. So for Parkway itself, their business is within the healthcare sector and they run in the real estate industry. So that's the thing that you have to clarify and to be clear about first. So currently, the reason, and the second thing, the reason why I decided to look into them is because they have a responsible corporate structure. at this point of time, given a COVID situation, they're setting aside 850k Sing dollars aside to aid the COVID in terms of if let's say there's any form of escalation. And looking more into their revenue stream, as we can see here, I'm not sure if you can see my mouse, the revenue stream itself, they are currently, with their current property valuation close to $2 billion, which is here, across 53 properties. So they currently own 3 hospitals, which is in Singapore, 48 nursing home, and 1 healthcare related assets in Japan itself. Then the last property is 1 clinic in Malaysia. So how the revenue stream is going to be like is stated here. So 40% from Japan, 60% from Singapore, and the remaining lesser than 0% is from Malaysia. Sorry, lesser than 1%. So if you look at the growth itself, they have astounding, not say astounding, but a decent growth of 160.9% growth since the IPO, which is in 2007, due to their constant revenue stream. So if you were to invest, let's say you are the investor right now, right? Even given the current situation, if let's say you were to invest 3 years back in 2016, you actually realize a 38.7% capital gain profit despite the current pandemic. So in the sense that you're still in the green, you're still doing well given the current situation. So moving forward, economic mod itself, it's essentially trying to say what are the, what are their advantage, what are their compared to their peers, why are they so outstanding in a sense, is that healthcare, you need to understand healthcare is an essential service required regardless of the pandemic or financial crisis. So regardless whether there's whatsoever, people still need to see a doctor if they are sick. So they are founded in 2007, 13 years history of earnings distribution to investor, which is very consistent and something that you don't get to see quite often in a lot of companies. They have outperformed STI since mid-2019 and S-REIT, Singapore REITs, in the third quarter of 2019 itself, as seen here. So Parkway Life is actually the cyan blue, whereas the darker blue is S-REIT and the pink color is STI. So they have high occupancy rate of 99.7% at this point of time. 100% occupancy coming from both Singapore and Japan, which is a very good number, and 31% from the Malaysia clinic itself. So therefore the resulting the number of 99.7%. On top of which they have amazing lease agreement. So when you want to look into real estate property, you want to see whether how they generate their net revenue, which is mainly from property or rental. So with 100% of individual one is pretty awesome in a sense. They do guarantee a 1% annual rental escalation. What do they mean by that is the rental will only remain and go up and will never come down. So every revision is either they maintain the same rental, means you're earning the same amount, or they increase the rental, means as an investor you do get additional. So consistent DPU as seen here, which I have covered earlier. Okay, moving on to their financials itself, year-to-year growth in terms of revenue, low cost as we can see from here. They have a high gross profit. Reason being is because the cost of revenue is pretty low, and they has continued to do it for the past few years, as indicated. Balance sheet itself, they are pretty healthy. A really high assets to liability, but we still have to take into consideration that it's because they own real estate property, which is considered as an asset. So we have to take that into consideration when looking into this company itself. So they have a 38.5% gearing ratio, allowing I would say a margin for more debts to take place. So for REITs, I tend to look for REITs that has a gearing ratio of less than 40%. Reason being is you don't want too much debt which will consume the assets itself. So that's what I'm looking at. And for those who are familiar with the REITs industry, gearing ratio I think previously was set at 45%. Reason why they raised it out to 50% was because of the current COVID. The government has new measures implemented. Therefore, now the new headroom is 50%. Okay, the upside. Now we share about upside. So now we need to know the downside. What are the potential risks going out there is that we need to know amidst the current situation, irregardless of which industry you add, everyone will not be doing as how it's like when times are good, unfortunately. So I will say I summarized into 4 different risk factors that we have to look into: short term, long term. Short term will be the current COVID situation. So as in additional measurements take place, to prevent, to aid their patients plus the staff there to take good care of them, to make sure that they are not ill or anything. This one all need money. So yeah, so they are costs in a sense. Long term one will be a technological advancement, artificial intelligence. So maybe in the future you don't need to go see a doctor face to face. You don't need a physical property. You probably just need a computer. Talk to an AI. Then after that, a medicine will be scripted, and after that sent over to your place. Increment in medical expenses, continuing from advancement technology lah. So as things get better, things will also become more expensive. 3D printing, which is happening now. I think the successful 3D printed organ is a bladder at this point of time, which has successfully been printed and implant into a human. So the next question is, what are the next organ that they are going to print out and put in the human? So this is a possible disruption. And if let's say Parkway Life is the hospital that doesn't, follow suit, you might, do some of that. So the second one will be a competition in the growing market, decreasing in foreign patient. So as other economy are booming and everything, so for example, Indonesia Korea all their medical sector start to advance in their technology and stuff like that. Patients wouldn't want to come to Singapore anymore, so that's the downside. For Japan itself, will be natural disaster like such as like earthquake, as well as the currency exchange rate. So the valuation of the Japanese yen. So that's the 4 risks that I would assume that would probably affect this particular stock. So for valuation wise, they are currently valued at close to $2 billion given the current share price and the outstanding shares. So what I want to look at is their P and their P price to book value, which is this area here. The bottom one shows you the peer comparison, which outright, I would say in terms of comparison wise, their valuation is still better. So looking at this P and PB, they are currently trading above their 5-year average. However, I feel that even though it's, I would say, a little bit expensive, but in the long run, it's going to be worth it because we have to know that company will still expand. So in a sense that this valuation will definitely go up. So whatever we are buying compared to just last year itself is still considered around fair value, I assume. So yeah, we have to look at it more of the qualitative aspect instead of the quantitative valuation. So last but not least, I think I want to conclude this whole thing by saying that why this company is good. Yeah, despite the particular risk factor, but I am sure basing on the annual report stated by their own CEO, that they will look into R&D and stuff like that. So business has outperformed their peers hands down. And there's a stable operation irregardless of COVID. So even the current pandemic, they are still able to distribute dividends to their investors from their first quarter report itself. Steady and sustainable growth since COVID-19. So no issue on that, no qualms. The yellow one is Parkway Life. The blue color one in the chart is STI, by the way. So yeah, they has enhanced debt ratio, which is up to 50%, temporary lift-off measurement from MAS, strong defensive quality of average listed expiry of 6.4 years. So you can view them as like a contract. So together with the tenant, they got about 6 years contract, which is pretty good. An amazing rental agreement means the rental will only go up, will never come down, or will remain the same. Yeah. So I have concluded my sharing. If you all got any question, yeah, you all can start asking now. Yes, sir. Okay, any questions so far? You all can ask either 3 of us, then we'll answer your question accordingly. If no question, ask your question.
Okay, ask about the stocks the companies that we shared or the industry wise.
Hello.
Yeah.
Hello. Yeah. So just want to ask, right? So after you do this fundamental analysis, right? How do you determine your entry price?
The entry price.
Yeah, correct.
Okay. Like I mentioned, I'm a fundamental analyst. I don't have a specific entry price, but I will say I'll base on the current valuation, and I not tend to buy on the red days. So what I mean by red days means like when people are massively selling the stock price over. Yeah. So like I mentioned, so if let's say given the current volatility, I won't give you an entry price to get in because I really don't know. But then one thing I can say is value averaged in. So if let's say the current valuation determines that the stock is probably overvalued, So let's say, for example, you use PB, PE, then you use their debt ratio kind of thing. Then you realize that it's very expensive, means overvalue. You probably can buy 100 shares for now. Then, however, in the subsequent future, maybe a few months later, you realize, they are currently below value. So maybe you can buy even more. So instead of 100, you can buy like 500 shares. Yeah. So I would say depending on the current valuation, but not the specific stock price. That's how I do my investment. Yeah. Hope I answered your question.
Okay, so for Adrian, he's not really like he's kind of full fundamental. So for me, I use a little bit of technical. So like he said, you know, we use all the ratios and you find that the price is, let's say, 150, and it's the current price that you value is 150. And what, yeah, like optimistic or not. So let's say you're optimistic that the price is a bit high. If you are quite pessimistic, it's a bit low. So let's say you were a bit pessimistic, your valuations, the inputs you put in, they were quite low, and you got 150, but the market was 170. So maybe you can, you know, a little so-called margin of safety. You could have went to like, oh, maybe because I was pessimistic, you know, when I entered all the valuations. So it could have been 170, or it could be 160, you know, it would be an upside of 150. So I think that's a good indication also. And then you can use technical analysis. So technical analysis is good for entry. So let's say you can use moving average, RSI, yeah, and then all these technical analysis, like in moving average, when the 50 and the 200 crosses, and then there's RSI and the MACD. So if you look into all this, and then you can decide whether in the very short term, like 1-2 weeks, whether it will like really go down, or you know, it will go back up or down in a very short period. Like let's say you very giam-siap, you want to really buy at the lowest point in the week, something like that.
Yeah, so basically for my view, for this Maple Trust, I actually noticed about this stock few weeks ago. So it was actually recovering from the dip of COVID-19 stock market crash. So before it crashed, after it crashed, actually it was trading about 90 cents, $1.90. So right now it shot up to $2.50, $2.56. And I did not regret it because back then I didn't know this was a quite defensive and reliable stock. So basically, if you ask me right now, if I have enough watches, definitely I will buy, or I will dollar average in every month, like what Kai Chin said. Yeah, there's actually a lot of dollar averaging brokers out there I know, which is I personally use Poems. So yeah, but if you want to dollar average in, there's actually a special few accounts that allow you to do that, rather than buying it in a normal way where you have to pay $25 or $28 per trade, which is more expensive than if you were to use those kind of special account to dollar average in every month. Yeah.
Okay, yeah, thanks. So now answering Venom question is the amount of money we put into other shares already. So yes, correct. So at this point in time, if let's say given that you have limited amount of money, and if you feel strongly in the business, then yes, you can wait it out for the business to become undervalued. Or you can just purchase it. Because what you want to do as a fundamental is you want to invest long term. So it's irregardless of the share price, you believe in a business that will take them further in the next 5 to 10 years or even 20 years down the road. So that's something you want to look into. So buy price to me, it really doesn't, I would say it really doesn't matter. Yeah. But of course, we are limited to the amount of money we have, given that we are student and most of us aren't working yet and we still have other bills to pay. For Arthur itself, share the reason why the stock of a company is undervalued, perhaps with an example. So so like what I mentioned earlier, currently the ratios itself, as well as the past indicator. Yeah. Wait, let me think of a way to share with you. Yeah. Y'all got other opinions, Nick and Tian Mu, while I think of one way to explain.
Wouldn't you put that amount of money into other shares?
Okay, basically, I would like to branch in further into dollar average in every month. Basically, minimum I think is about $100. I read before, but I can't remember what the exact details. But they will the commission is about 0 point something percent or at most 1 point something percent. Yeah, but I think that is more worth than if you were to dollar average in every month by using the standard $28 because if I were to do that for myself, Kaijin taught me that basically keep the transaction fee lesser than 1%. Yeah, so if 1%, basically each trade, you need to trade about, I think, $2,800 for it to be 1%, right?
Yeah. Okay, yeah, sorry, Arthur. So to answer your question, I feel, okay, like I mentioned, like I don't really believe in a fixed buy price lah. So if to me undervalued is like going for Great Singapore sales itself. So if let's say, irregardless of the needs of getting a certain kind of product, okay, let's say for example for food, you die you need food. You hungry, you still need it, correct? So if they jack up the price by 50 cents, you still have to pay. You still got to eat it because you're hungry. But if let's say they reduce the price, is like you're getting at a discount and you probably are more happy because now you spend lesser money. So similarly to stock price, if let's say during the market itself, you know this business is going to sustain through the tough time, you know, the downtime, and you believe in their current business, their management itself, their team, their business model, and the strength in their balance sheet means the financial health, then yeah, you can put, technically you're actually buying in terms of buying at a lower value, which is under fair value lah, which is below intrinsic. So in a sense, in that case, you're actually buying, yeah, undervalued stock. But in probably if let's say during normal good times, during a bull market or so, you probably would be buying where the company is slightly more expensive. Cause like I mentioned, if the company is really damn bloody good, then during good times, you'll definitely do even better compared to average company. And downtime is the time whereby we can purchase this kind of company at a certain kind of discount, despite their valuation probably above the average, which I shared just now regarding the Parkway. Their current 5 years valuation is slightly above. Sorry, their current valuation is slightly above their 5 years average. So yeah, hope I answer your question. No, it's not solely because of bad market condition. Can be because of news and everything. So we can't exactly tell. I would say I don't know how to time the market. I don't know when it's going to be a downtime, when it's going to be an uptime. But one thing I do know is really have to understand the company. Yeah. Okay, Tian Mu, you might want to answer this question about combine technical analysis with fundamental.
Okay. Where is it? Sorry. Okay. Madman, please tell me how you combine. Okay, so the one you got the okay. So I'm assuming with this question, I'm assuming that you're quite a long-term investor because you look at fundamentals and then you wanna enter in with technicals. So normally this is what I think most people do and what I'll do also. So number one, you analyze, you evaluate the company with all the data that you have. You use free cash flow or dividend discount model and all that, and then you come up with your price. So I think I was being a bit fast just now. Let me just like repeat again. So let's say you you evaluate this company at $1, and when you were evaluating the company, for their growth, right? So let's say the growth is, let's say, 10%, projected to be 10%, but you're a bit pessimistic. So you put it at 7% per year, and then you grow it at only 7. You put in all the pessimistic number, a margin of safety, you put in all the low numbers, and then you get your valuation. So when, let's say the stock is at $1 now, and you evaluate it at let's say 80 cents. So at 80 cents and $1, there is like a 20% difference. So you could, you can ask yourself whether you think that, you're being too pessimistic about this stock, or, or you feel that you're still right. Okay, so that was the question for just now. So if you're optimistic and you put in all the, let's say it's 10% growth, then you put in that, 12% growth and all that, and then you got like 120, then you think that it's undervalued. Okay, so it really depends on what the price of the market is, and then if you're pessimistic with all the low numbers and growth, it's going to be lower. If you're optimistic, it's going to be higher. So it's also a point of view. So let's say you get, okay, to this question, you get the number now. Okay, let's say okay, so the market price of this stock, it's $1, and you got the number at 90 cents. So if you die want to get 90 cents, you look at the technical side. So for the technical side, you have to use the, okay, so some of the things I look at is, because it's a wave, it's always a wave. So it will go up and then it will come down and up. So there's like also support and resistance. So when it goes up, if you think that we are at this little wave, if you think that you're at the top of the wave and it will come down to the resistance, then if you can see it using moving average, using RSI, MACD, and if you feel that it will come down, then you just put in the price when it comes down. So if you have technical analysis, you will understand what I'm saying, because I don't really have a graph. Unless you want me to, if you want me to use a graph, like a real life example, then I can try my very best to find one. Yeah, but if you use technical analysis, you'll understand.
By the way, for those of you who want to know more about the dollar averaging cost, right, I'm going to place a link here. This is by Poems. I've searched it before. Yeah.
Okay, so to answer back to Arthur's question, like, is there a one-way method to evaluate a particular stock? I will say no, there's no one way to evaluate. For example, understanding from a tech industry, a healthcare industry, a finance industry, there is different ways of valuation. So I would say that there is no one method fits all solution. Yes, so different industry, different companies, you must evaluate them separately. Yep, that's my take.
Can you hear me?
Yeah.
Great. So, okay, I understand that there's no one-size-fits-all approach. But the thing is that, what are some common things that we can look for? Like, we want to find out, okay, a company is undervalued. If not like that, everyone and their mother will go and invest in undervalued stock. So the thing is that there must be a reason why certain stocks are undervalued. What are some of the telltale signs? Because you mentioned news is one of them. So maybe I am not so sure because I'm not familiar with this in detail, but you mentioned news is one of them. So I expect maybe someone leaked something to the press, then after a lot of people are talking about it. So that's one way of it, But are there other things that we can look out for as to why certain like common traits that you can see? I understand like for different sectors, it might be special. So that's why I was hoping like maybe, I mean, it doesn't have to be this session that you share about it. Just hoping to know, like, if you were to look at a company, then after you find that it's undervalued, is it possible for us to try to like break down and analyze why it's undervalued? Because this is just my hunch, like the undervaluation of a company is not simply because of news for no reason. Sometimes the news can be scandalous because of something going wrong at top management, for example. But that will also affect the fundamentals of a company in the short term, maybe even in the long term. That's the reason why it might be undervalued on paper. So I was just hoping to see whether like you all have any experience that you all can tap on to talk about companies like this.
Okay. I need to address your question. I don't have a for sure answer. I mean, if anyone disagree, this is just solely my opinion. Solely my opinion. Please don't quote me or anything. But I would like to share is that to determine whether a company is undervalued or overvalued is really up to your own personal research and finding. So for example, to me, I feel Tesla stock is currently very undervalued. I feel Walt Disney is very undervalued. Correct? Given the current COVID situation, that they do have a future potential upside in terms of when the COVID situation is done and dusted, there's vaccine for everyone, then business will resume as usual, you know. So I feel that Disney and like maybe Tesla, they are currently undervalued. But however, in the near future, I mean, like, no, sorry, not in the near future, but currently maybe someone else, you know, maybe a Tian Mu or Nick, they might view that Walt Disney is very expensive because Walt Disney, the current price is $100 per share. Compared to just now, the one I share with you, Parkway Life, is starting only $3.27. But obviously, we cannot look at just the price itself to determine the valuation of the company itself. So to someone else, we might feel that, hey, cannot Walt Disney 太贵了. Because 40% of their revenue is coming from the park itself. And if the park all closed down for the next few months, where they going to get the income from? Yeah, so they will feel that this current company is overvalued, like too expensive, 太贵了，不值得买, like not worth it to get it now. Yeah, so whether you want to determine your stock is value or undervalue, I think you would really determine on your individual, your own research, your own report, your own understanding of their business model and stuff. Yes, you can, you know, take in research. I mean, like other researchers, their opinions, you know, your friends' opinions, your the news and everything. But that's their opinion. You still have to make the decision yourself to determine whether to you is it still worth. Because you have to know that as an investor yourself. I mean, I'm a fundamental investor, so I need to invest in the sense that I must take it that I'm the CEO of the company. Do I think this company is worthwhile to put my money into or not? And do I like the way they run the company? That's the thing. So you have to ask yourself that question. Are you, with the way they're running their current business, is it acceptable to you or not? Or is it, are they wasting too much money? For example, like Grab or this kind of company, like WeWorks or this, WeWork recently filed bankruptcy, this kind of company. Like, they really burn cash one. So you need to ask yourself whether you can tahan them or not. Like, are they within your kind of, your likings, I would say, to a certain extent. Yeah.
Whether you agree with the philosophy or how they run their company, basically.
Sorry?
Whether you agree with how the way they run their company, basically.
Something like that. Because I read, like, fundamental, I really look down into the valuation, the corporate governance, like how do they run the company itself compared to their peers? Are they the leading within the industry? So these are the few things that we have to look into, I feel. And the future outlook, for example, like 3D, the technology improvement, like they literally can print an organ out and implant into a human body. So that's something that you need to consider. Are they leading in that aspect in their R&D? So that's something you have to ask yourself. Yeah.
So okay. At 11:01, L said, I believe you don't have to understand fully why something is happening. Bottom line is giving an opportunity to go in with a cheap price. Yeah, it's quite true to a certain extent. If you trust yourself, you evaluate, and you find out that the market is undervalued, then maybe you just found a gem. So this is what Warren Buffett, at the later on, after he stopped buying like cigarette butt companies, he always looked for undervalued companies. Then he will try to go in and buy and own. So okay, you're saying news, right? So some news, they are like kind of noise, and some news, they are not really noise. It's really important, like you said, the management doing screw up, or the CEO gonna die, then no replacement or whatever. So okay, you can go and, so for me, right, I believe that Wall Street, they kind of hold a very big stake in the market, because everyone's money, like mutual fund, hedge fund, all the money, right, is kind of there. So they are kind of the ones who move the market in a way. So maybe that stock, they don't look into it. It's not under their radar yet, because they are parking their cash in Apple, or they're parking their cash in all the big names you can think of: Apple, Microsoft, Amazon, all these big names. And then if you're looking at undervalued stock, you will probably be looking at not all these big names, because if they are, they'll definitely be, I would say they are all overvalued now, and they're always overvalued anyway. And then so I think you'll be looking at maybe small, not small cap, but like really small stocks. Let's say the REITs, or Sheng Song for my case. So only when all these things get okay. So when the institutional investors, they find out about it, and then they talk about it, and it goes into their radar, then someone buys. They use billions of dollars to buy the share. Obviously, supply and demand is going to cause the share to rise.
Yeah.
Okay.
I believe it's time for the last question for us. But I would like to address Madman's question at 11:04. Do you guys believe being in buying stock using news, or is it better to combine with both fundamental and news? So basically for me, I have a clear strategy of what I want and not let all these external news to manipulate my strategy. And yeah, because COVID-19, a lot of sell downs and people are not, people are not disciplined enough to keep those stocks. And because they know that if you agree with me, whatever goes down must come back up. So if you were to see now is slowly recovering, but the thing is, I also do look at news, I do look at forums, I do look at blogs, I do look at opinions, all these things that factor into it, as well as the critical ratios. But I feel that you guys have been talking about price to book just now. I feel that that is not only the thing that we should look into. There's so many things, like 101 things to look about it. And it should just be an indication. It should not be like a very critical criteria, I feel. Yeah. You guys got any comments?
Like, maybe it's the last question. Very,
Okay. Yeah. For Arthur, I think you can share what on this case. Then we'll wrap it up as a whole. Yeah. Before we wrap it up as a whole.
any like really burning questions? I feel like we
Okay, Arthur, I'll take your case. I'll take your question offline. Then I'll share with you. Then for those who are interested or anything, you all can PM me. Then we can do a offline discussion. Cause 11 now. Some people want to sleep already. Yeah. So I think I would just like to, at the end of it, I just want to thank everyone for spending an hour together with us to share this whole thing. A little disclaimer is that this is a sharing session itself. We are not financial advisors. So if let's say you want to take further action or whatsoever, please see your own consultant or do your own necessary research lah. If y'all got any question, then do try to ask. Y'all can take it offline. We are more than happy to come with you guys. And for those who are interested in the investment group itself, do drop either of three of us your interest, then we will add you in. Then from there we can discuss on companies to look into, the daily news and the future outlook and stuff like that lah, to have a little bit more discussion other than just doing it one time off per week kind of session. And for those who are friends with Tian Mu and Nick, I will thank you. If let's say you are interested, I'm selling myself a bit lah. So if you're interested, I'm actually doing a Tuesday weekly webinar to share more about the economic, the investment and stuff like that lah. So if you are free, you want to join, you can get the links from them. Then yeah, I'll see you next Tuesday itself. To the rest of my friends, I really appreciate the time and to coming online lah. Yeah, a bit lost all here, but I'm actually really very grateful for you guys coming over and staying for that hour or so. I really do hope that through this session and all this sharing, time and effort has been put into it lah. So I really hope that it can benefit one way or another for you guys in terms of your financial journey itself. Yeah. So I would like to conclude the end of this session. Yeah. Thank you so
everyone.
very much.
Thanks.
Y'all
Thank
can
you.